Hello again, everybody. Well, any experienced investor will tell you that the art of investing can be a very humbling experience. You know, things are going really well and you're picking stocks that are making money and everything is going well. It's a bull market. And you better be careful about patting yourself on the back because there's Mr. Market lurking in the shadows, just waiting to pounce at any time, taking his pound of flesh in the next bear market. So you got to learn humility when it comes to investing. You don't get too low when things are going poorly, but don't get too high when things are going really well. You just keep your head down, keep learning from mistakes, and you'll become a successful investor. So when I title this episode as I Told You So, that doesn't sound very humble to me, does it? It's tongue in cheek. I'm having fun with this, but it's really instructive because what I'm going to do is take you all back to one of the first episodes I recorded back in January. And I told you at that time, be careful about getting caught up in all the hype that was going on at the time in the stock market. All the record highs as President Trump was about to be inaugurated. Now, why would I have said that? Why would I have gone off the range and become a contrarian and said something that was opposite of how most investors felt? Well, I'm going to tell you that in this episode. I'm going to tell you a little bit how the sausage is made in my corner of the world to perhaps help you become a better investor yourself. So, as we go back and look at one piece of this episode, what I was reminding people of where we were in the market at the time. As I just mentioned, everything was going very well. Market was hitting all-time highs. There was a lot of hype in the market as this new, not really new because it was his second time around, right? President Trump. But as he was bringing in the new administration, there was a lot of expectation that this pro-business guy was going to open up business again and Wall Street was going to react favorably to that. Here's a piece of that. There's a lot of expectation with Donald Trump coming back in from a business perspective. There's a lot of expectation that the financial markets are going to do very well. They've already been doing well. Everything is priced to perfection. So that was basically 10 minutes of an episode where I told everyone to just be a little cautious. And by the way, if you haven't seen that, please go back. The episode was titled, How Trump Will Impact Your Finances. Go check that out because I go into a little bit more detail about comparisons between now, 24, moving into 2025, and back more than 40 years ago as 1980 went into 81 with Reagan coming in with his first term. Now, I'm not going to go through all the details of that again here, so I encourage you to go back and look at that if you haven't, because that will put things that I'm going to talk about today perhaps into some context. But here, in the here and now, as we started the new year, as I'd mentioned before, we're hitting all-time highs. And most investors, and I think rightfully thought, that we're going to see regulations cut. We're going to see perhaps more mergers and acquisitions, maybe even corporate taxes cut. And Wall Street, of course, would react very favorably to that. So along comes little old me to tell a different story back in that first episode. It wasn't to predict a crash. It wasn't to say a bear market was upon us. But I said, folks, just check your enthusiasm at the door, right? Everything was priced to perfection. Let me tell you one of the things that I look at, more than fundamentals, more than what the economy is doing. To me, one of the most important things that investors need to look at to try to divine that maybe where the market is going near to intermediate term is taking the pulse of the investing public, investor sentiment. And it was through the roof in January. As I just mentioned, that line that you just saw in the one of the first episodes this year was the market was priced to perfection. Any little thing that would go wrong when there is so much hype would cause the market to perhaps sell off, and that's what we've been seeing since February into March. I don't know where the market bottom is. That's not part of this podcast. Nobody knows where that is. The point is, I sensed it back in January when most people didn't because of investor consumer sentiment. Let's put up this chart right now, and I'll tell you what I'm looking at here. This is a weekly survey conducted by the American Association of Individual Investors. I am just going to focus on that left column. That's the bullish percentage. Know that this survey, which has been around since the 1980s, has a long-term average of a bullish percentage of 37.5%. Look at that first date, October 23rd, right on the average of 37.7%. And then look where it goes. It goes higher and higher through the election, topping almost 50%. And then it starts to stabilize a little bit. But it stays above average for most of that time. And now look, at the end of this particular survey that I'm showing, it starts to get back up into the 40s. And look at that, right as President Trump was inaugurated that week, the bullish percentage goes back to 43.4%. So people who have known me for a long time, clients, people who listen to the radio show, get my weekly commentary, know that I am a contrarian and know that I look at investor sentiment. It's not foolproof. Let me be very clear, and I think most of you know this. Nothing is. There are no guarantees when it comes to investing. But I have found over the years in my experience, when you take the pulse of the mom and pop investor, and then you take the pulse of the institutional investor, and when you see both sides are very giddy, very greedy, and markets are hitting an all-time high, I'm not saying you cash out. This isn't about market timing. It's about just being careful not to get caught up in all the hype and hoopla. And that's what I was sensing. That's why I even recorded that podcast back in January to say and to tell people, don't mortgage the house here. Don't start investing in a lot of tech stocks. Now is not the time. This, like I said, is not about market timing and going all to cash. It's just about trying to be prudent and trying to be reasonable. Now let's go back to the survey because I want to update it and bring it more up to date here. As you can see, the sentiment numbers have been falling off the table in recent weeks. Look at some of the last couple of weeks, down below 20%. You know how rare that is? It has been years since we've seen bullish sentiment in back-to-back weeks below 20%. Now, as a contrarian, you would look at me and say, well, Dave, is it now time to turn bullish? You have just laid out the case, as you did in January, that things were way up here, a lot of excitement, a lot of hype, everything priced to perfection, sentiment through the roof. Isn't the opposite true now? Sentiment now way down, markets have corrected? Great observation. I don't know. How about that for an answer? You tell me where the whole tariff picture is going. You tell me what the end game here is. Nobody knows. Everybody's crystal ball is never perfect anyway. There's always a little fog on the side. Well, right now, I think our crystal balls have just shattered all over the place. So one of the things I can guarantee you is I will not use this episode in a future episode to come back and say, hey, go look at the one that I did in March, because I'm not making any predictions this time. Not nearly what I did in January, because it's very, very difficult to try to extract what's going to happen here. But I will say this, know that by the time you actually see this, maybe the tariff war is over. I don't think so. I think this is going to go on for a while. But look at these sentiment surveys. Another good one, that CNN has a CNN Fear and Greed Index. You can do your own research. You can find that online. But when these things match up and sentiment is way down on that AAII survey that I just showed, on the CNN survey, there are all kinds of sentiment surveys. And if they all come into alignment, and they're all either way up here or all way down here, again, no guarantee, but history tells us that's a pretty good indication that the opposite may start to happen. So we are very, very oversold here. But I'm getting too caught up, and maybe you are too caught up in the day-to-day activities, the day-to-day machinations of the market. Let me show you a picture here. And as the old saying goes, a picture is worth 1,000 words. Well, this one is like 1,000,000 words. It's so simple, but it tells a great story. Too many of us as investors, we look at that left side. That's how we live as an investor. And it's wrong because look, the line is going all over the place, but doesn't really end up going anywhere. We're not reaching our goals. You gotta focus on that right side of that wonderful picture. It's not about days, it's about decades. It's easy, I understand, to get caught up in the news headlines of the day, but that unfortunately affects us too negatively as investors. So I hope you go back and look once again at that first Trump video that I talked about to glean some of the things that led me to go back and say, I told you so. I'm trying to be humble, and I am, but it's very instructive to understand why I am the contrarian that I am and how that has served me well for so many decades. Please hit subscribe. Pass this video along to anyone you think might benefit from it. That's it for this week. We'll talk to you again next time.